Welcome back, everyone. So we're pleased to welcome now to the Element Wealth Studio, relocated to the Oxford Convention Center. It's Gordon Fellows, president of the Mississippi Bankers Association, and Ann Balcer, the senior executive vice president. That would be the Independent Community Banking Association. Did I get that right? Close
enough.
Okay, Ann, appreciate that.
We like our long titles in Washington. So.
And you are the chief of government relations and public policy.
That's right.
And so do you work primarily in Washington on those matters?
I do, although, as you can imagine, I like to get out of Washington pretty frequently, especially meeting with our bankers around the country. Wish our policymakers would do the same.
Of course.
But times are changing.
Indeed, they are. So, Gordon, we were talking to Dean Sirey earlier. Huge attendance this year. This event just seems to get bigger and better.
It does. And the association doesn't have anything to do to organize this, so it's my favorite event because I don't have to do anything. I just have to show up. But the folks that lead this have done an excellent job. They raise a lot of money that gets invested back into the business school and into scholarships for students. And just like any other industry, we need new bankers, right? So the role the universities play in producing good quality graduates into the workforce in our industry is critical right now.
Yeah, no doubt about it. All right, so, Ann, you're not busy after Tuesday, are you?
I think I'm still catching up on sleep, but
so am I.
We're still counting votes, too, I think.
Yeah.
Oh, my gosh. It really seems to me that there shouldn't be a great deal of difference in who is running the government at Washington as far as that vis-a-vis the banking industry. But the philosophy of the parties about the banking industry in general and just business in general seems to be splitting. It's becoming more polarized. This could be sweeping change for the banking industry, just ushering in a new president that has kind of a different outlook on banking. Business in general, who are going to be in positions of regulatory authority, who's going to be the Secretary of the Treasury, for example. You guys are paying attention to this, I'm sure, right?
We are paying a little attention to this. I think the fact that we've seen these agencies become so politicized over the last few years has been something that's really changed. And it's really unfortunate for ultimately, at the end of the day, the consumers and the small businesses are the ones that are impacted the most because of restrictions that lead to loss of credit opportunities.
Yeah.
And so that's really, what we're looking forward to is hopefully a shift from this really academic type of approach where things are all sort of decided in a bubble in Washington to folks that hopefully bring, a little bit more real life experience and outlook. And quite frankly, because this is a second term for President-elect Trump, we anticipate a smoother transition, I think, than we saw in the first administration.
Okay. And Gerard, I'm going to jump in, too. I think you'll find this interesting. So I know you're a stat guy, so I looked this up before we got here. President Biden, in his 4 years in office, generated 1,070 rules that, according to the American Action Forum, have a total combined aggregate cost of $1.8 trillion, right? And so compare that to President Trump before, 1,180 rules with a combined cost of $3 billion. So regulatory cost across the whole economy goes from $3 billion over 4 years to $1.8 trillion. We're in the middle of that. And so Ann's point is right. This hits consumers, and it hits across the all sort of sectors of the economy. So the next few weeks, as we learn who gets appointed, will have a real direct impact on what that ultimate dollar amount is and what it costs Americans to be regulated.
Well, and I will just add to that the recently finalized Community Reinvestment Act regulation. This is a fun fact I also just learned. We get from the birth of Christ to the resurrection of Christ in fewer words than the Community Reinvestment Act. And that just really tells you where we are.
1,500 pages is too long for anything.
It's too long. Yeah. So that's where we are. But, I mean, we are a bipartisan, association, and we work with both sides of the aisle. And so, I think this is going to be refreshing for both sides, honestly, because there are, some fiscally conservative or even moderate Democrats that have had struggles and have heard complaints based on just the treatment by some of these heads of agencies.
Well, I feel like, Gordon, you made me look smart there. Smarter than I am, because in the prior segment, I was just talking about that it's overlooked and it doesn't get a lot of attention, but the cost of compliance is massive, and ultimately that gets passed on to consumers. So I said in the last segment that the various ESG reporting requirements, especially on your plan to mitigate the possibility of significant climate change. I mean, we're asking banks to be meteorologists, essentially. It costs a lot of money to put all that together. We ultimately end up paying for it.
And let's be realistic. Banks have managed their risk for years.
Yeah.
And
better than any other industry.
Better than any other industry. And the further we push down, and this is a conversation we've had many times with the Biden administration, the further you push down on the regulated entities, the other, the individuals still need credit, right?
Yeah.
They still need access to financial products and services. So now you're pushing them out of mainstream banking. And that's, the U.S. economy is the envy of the world for a reason.
Yeah.
And it's because we have the diversity of banks located in very small communities to pretty big, urban areas. And that's, as we know, that's what drives, prices down and increased competition. So your listeners know that. Unfortunately, folks in Washington have forgotten that.
Man. So, Gordon, we were talking to George Gammon, who, of course, is the regional president of the Citizens Bank. I know you work with him a lot.
Right.
It wasn't too long ago with Silicon Valley Bank and Northeast both failing that there was lots of fear-mongering going on about what we could expect. And something else that we talked a lot about was the possibility of problems to banks with credit quality with respect to rolling over of some of these commercial loans that we're going to have to be refinanced at a much higher rate. And then we had lots of potential problems with real estate. What's happening there? I don't hear a lot about that.
So I think in our state, this is less of an issue than in other places around the country. And if you kind of think about it, it makes sense, right? We don't have big office complexes in cities like San Francisco, right?
Yeah.
So the commercial real estate challenges in Mississippi have been more around like elder care homes and stuff like that, right? So it's much more absorbable because of the scale of how those projects are done here compared to where they are problems. So there are parts of the country that have seen this as a challenge to credit quality, and can probably speak to that where she lives, right? But where we are, we're fairly well insulated from that. And what's been kind of challenging for us is, to Ann's point about sort of the regulators in a bubble in D.C., it's hard for those folks to sort of see the variations in the local economies. And so, one of the jobs of the bankers is to sort of continuously educate their regulators. This is not a problem here in the way it's a problem in a more urban market.
And what are your members telling you they need out of Washington with a new sheriff in town, so to speak?
Just regulatory relief. Our banks do right for their customers. Yeah. And we even have, I like to look at academic research, particularly since we've been dealing with an administration so focused on it. We actually even have academic research to support that community banks are not, discriminating. They're not price gouging. They're not doing any of these things that have created this sort of, the ill will towards banks, so to speak. And so, our banks want to just be bankers. They want to contribute to their communities. They want to continue to operate and be here, for another 100, 150, 200 years and beyond. And we need some change. We just absolutely need some tailoring, some relief, and honestly, common sense. I mean, we've just lost, any common sense.
Well, it works out because it's highly competitive. So
That's how the market works.
That's how the market works.
Yeah.
We don't need government to come in and make sure everybody's acting right. No, the market makes sure you.
There are only so many Harvard and Yale PhDs that can tell you this.
They all called it wrong, by the way.
They all called it wrong.
400 of them said it's transitory 2 years ago.
Yeah.
And,
until it's not.
Until it's not.
So we have a panel at 1 o'clock that we'll be doing on what the regulatory horizon is.
Okay.
And it's kind of funny because we prepped this before the election. It's like, oh, okay, all these questions that we had are kind of different now. The topics are the same topics, but the light is that we're going to ask them in. It's going to be kind of a different kind of light to think about them through. So there's a lot of regulation that's the bankers are still going to have to absorb, and sort of figuring out in Washington how to parse back the unnecessary pieces, but still focus on safety and soundness, because we don't want to be heard, as being said. We don't want to be regulated. We want to be regulated the right way, right? So getting that right is going to be really important over the next couple of years. I think.
I like to say we're preparing our Christmas list for January.
All over it. Gordon, Ann, thanks for coming on. Enjoyed having you guys.
Thank you so much.
Appreciate the insight. Yep, folks, we're stepping aside for a break. Once again, we're at the University of Mississippi Banking Symposium, the annual Banking Symposium in Oxford.